I welcome you to the next section. In the previous section, we were focusing on the financial statement. In this section, we will be focusing on one of the financial statements, which is the balance sheet. Section overview. What is a balance sheet? What a balance sheet consists of: assets, liabilities, and the equities of the balance sheet. Let's move on to what a balance sheet is. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and shareholders' equity at a specific point in time. Formula that is used in a balance sheet is the assets equal to liabilities plus your shareholders' equity, which is also known as A equals to L plus E. Keep in mind that once you have calculated your assets as a whole, your liabilities as a whole, plus your shareholders' equity as a whole, the liabilities plus the shareholders' equity should have the same amount that the assets have. If that's how it is, then your balance sheet has balanced. A balance sheet is broken up into 3 sections. Let's move on to the first. Assets. An item of property owned by a person or a company. The item should be a value, so it should generate income. For instance, estates, cars, houses, your laptops, and etc. We will focus on the current assets and the fixed assets. Your current assets are cash and other assets expected to be converted into cash. These assets are continually turned over in the course of the business during normal business activity. There are 5 major items included into the current assets. The first one, which is the cash and cash equivalents, short-term investments, receivables, investors, and your prepaid expenses. Your fixed assets. Assets that are long-term used in earning profit in the business. These assets include land, building, furniture, and so forth. Please note, assets play a very important role or factor in the balance sheet. So, you should always calculate your assets correctly. Let's move on to the second section of the balance sheet. Your liabilities. Money that the company owes outside parties. For example, suppliers' bills, the bonds, salaries, and etc. So we have your current liabilities and your long-term liabilities. Your current liabilities are those that are due within a year, and your long-term liabilities are those that are due over a year. An example of both liabilities. For a current liability, it would be your supplier's bill. For a long-term liability, it would be the bonds of the house. Then we move on to the last section of the balance sheet, which is your shareholders' equity. Now, the shareholders' equity is the value of shares issued by a company when the owners are shareholders. To calculate the shareholders' equity, it should be shareholders' equity, which is equal to the total assets minus your total liabilities, which is also known as E, is equal to A minus L. So once you have calculated your total assets and your total liabilities, and you minus them from each other, it should give you the shareholders' equity amount. Now, if you can do those three sections in a split second, then you will be a master of the balance sheet. Thank you for joining us in this section, and I hope to see you in the next section.